Let's talk about the time value of money, hopefully in an easy way that even this little tyke can understand it. Guess what? You just won $100 and you're going to put that in the bank and leave it there for 4 years and pull it out to have a graduation present when you graduate. So I'm going to put it in a bank that's going to pay me 10% interest. That's a very generous interest rate, but we're going to compound that annually. We're looking for the future value. As accountants, we're not very creative with names, so the future value is the value in the future, in this case in 4 years. We put $100 in, we get 10%, so at the end of year 1 we've got $110. But it's compound interest, so that next year you get 10% of $110. The third year you get 10% of $121, and then in that last year you'll get 10% of $133.10 to give you the grand total of $146.41. Not a very big graduation present, but it's something. So we could do that for as many years as we wanted, but you can imagine for 20 years you're going to get really bored doing that. So we want to look at what we did and see if we can come up with a formula. You look at the deposit of $100, and in that first year you multiplied it times 1 plus the interest rate. So I could have taken $100 times 1.1 to get to that $110 a little bit more quickly. And I did that, in this case, 4 times, so that's the number of years. So you can take the deposit times 1 plus the interest rate to the n, to the number of years, that's your exponent, and come up with that 146.41. If you're not good with formulas, we've also got a table for that. Some of your instructors will have you use a table, some will have you use a formula, and some will let you use your financial calculator. All 3 ways get you to the same solution. If you're working with the table, all I'd have to do is look up 10% 4 years is 1.464, multiply that times my $100, and lo and behold, I have $146.41. Let's do the opposite then. Say now you know you're going to need $146.41 in 4 years. Now we know from what we did before, the answer is put $100 in the bank today, but let's see if we can use algebra to get us there. We know 146.41 equals that future value factor times some amount, and so we could solve for the sum amount and come up with 100. So just moving things around, the amount of that we're going to need, the 146.41 times 1 over that future value factor, would give you the amount you need today. So we said accountants aren't too creative, so the present value is another way to say the amount you need today. So today's value, present value, same thing. That equals 1 over the future value, or if you go back to the formula above, 1 over the deposit or the payment times 1 plus the interest rate to the number of years is the formula to come up with your present value. Again, we have a table that did the math for us. So comparing our future value table and our present value table, you can see that the present value is just the inverse of the future value. 1 over any number on the future value table gives you the present value. You don't really need to know that, because all I could do is see that 146.41 times that 0.683 gives me the $100, means put $100 in the bank today, and at the end you'll have $146.41. Do you want to go back and look at that first year? Notice that what that is telling you is that if somebody offers you $100 in a year, you'd be willing to take $90.90 today, assuming you can get 10% interest, and that would be the same as $100 in a year. Well, now you've just won $100 a year. So you played a different kind of lottery ticket and you're just so lucky. This one's going to give you 4 payments of $100. We're still going to put it in the bank at 10% interest. This is called an annuity because we have more than one payment and we're looking for the future value. So this is the future value of an annuity. We get our first $100, we put it in the bank, we get 10% interest. So at the end of the first year, we have $110. But now we put another $100 in. So now we have $210 that's going to earn interest. So the second year we'll have $21 of interest. And then we'll put in our third payment of $100, which gives us $331 in the bank at that point. I'll get 10% interest on that $331. And so when it comes to the fourth payment, I'm going to take my last $100 payment. I'm going to run to the bank. I'm going to clean out the account that day, and I'll have $464 total to go buy the Xbox or whatever it is I was going to do with my winnings. The fourth payment, notice, doesn't get any interest. The very last payment, you just take the cash you've got, add it to the total that's in the bank, and run out the bank. Let's look at how we can do that in a little bit easier way than working through those tables. One way to think about this is I've got 4 payments. One of them's in there for 3 years, one's in there for 2 years, one of them's for 1 year, and one I didn't get any interest on at all. I just put it in and took it right back out. So I can just sum up the future value factors for each of the years and come up with the total amount I'll have at the end. But again, we've got a table that will do that work for us. If you look at it on the future value of an annuity table, that first payment it shows a 1, meaning you don't get any interest on that at all. You just put it in and take it out. But if you look at the second one, I take that 1 plus 1.1. That gives me the 2.1, 2.1.1.21. This is too many ones and twos here. But you can see those just add up, and that's where that future value of an annuity table comes from. The nice thing is they've done all the math for us, so all we have to do is take 100 times the 10% at 4 years, and there's that 464.10 that we solved doing it the long way. Okay, now you've won, but you can either take a lump sum or an annuity. If you watch the lottery, this is always a choice that they make you take. So you can get $300 today or take 4 payments of $100 starting at the end of the year. We'll start with the value of $300 today. What's the value of $300 today? Hopefully you said $300. If you're ever looking for the amount today, the present value of the amount today is the amount today. Don't overthink it. So what we'll need to do is find the present value of that annuity of $100 to see how that compares to $300 today. Again, there's a table for that. If we look at the present value table and the present value of the annuity, looking at the first payment, notice it's the same amount. That first payment is worth $909 today. So $100 in a year is worth $90.90 today. If we look at that second one, the second year is just $909 plus the $826. And then you just would keep adding to get to the particular year you're interested in. But since we have a present value of an annuity table, we just have to look at 4 years at 100. So that's 3.17 times that $100 means it's worth $317. What that's telling you is you're better off to take the $100 a year, because at the end of the fourth payment you'll have $317 rather than taking $300 today. Now that assumes you really do save it and you don't cheat, but in theory, you're better off to take the annuity in that case. The dilemma is always, which table do you use for which formula? And this really puts it all in one place. The name of the table tells you what you're solving for. So the future tables tell you what the future amount is. So that's what you're solving for. For the single sums, you'll either know the amount today or the amount in the future. For the annuities, all you ever know is the amount of the payment. Annuities always have many payments. The lump sums always are one sum. While you don't really need to know how all the tables fit together, I think it helps you understand what's going on. But if you're ever stuck on a desert island and you only have one present value table and you're really bored and want to present value things, at least you know how it all works. Hopefully that helps.